Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Are you a new or sophisticated investor wanting to learn how to operate a successful syndication business? For life-changing training from the nation's leading syndication expert, my friend Vinny Chopra has the training you need. Text LEARN, L-E-A-R-N, to 474747. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Dylan Marma. Thanks for being on the show, Dylan.
Thanks for having me, Whitney. Excited to be here.
Yeah, I'm excited to have Dylan on the show. Dylan began his real estate investing career in 2015. He quickly rose to a leadership role in a residential and commercial real estate investment company in San Diego. In early 2018, Dylan joined the team at Rand Partners. That's Jake and Gino, which most of the listeners, I'm sure, have heard of, and that to expand into additional markets throughout the Southeast, as well as to build out the systems to open up the doors for outside investors to partner through syndication. Now, at the age of 25 years old, he owns and operates over 500 units. So it's very impressive, Dylan, and I love having somebody in their mid-20s or younger on the show that's been as successful as you, and just to show that all these limiting beliefs is just they're just not true, right? That it can be done, and you're making it happen. I know you're playing a big role at Jake and Gino. I know they're thrilled to have you on board, and your all's business, as we were talking about, just growing. Your team's growing. It's amazing what's happening there. Just great guys, and just amazing what just their integrity level and their business quality is just fabulous, and it's showing. And so, Dylan, tell the listeners a little more about just who you are in case they haven't heard of you, and what your focus is right now, and let's dive in.
Yeah, absolutely. Well, I'm sure we can touch a little bit on my story, but today we'll start with where I am right now, playing a role within Rand Partners. I really play two different roles where I think in any business, as you're in this sort of the startup phase, which I still consider us in somewhat of a startup phase. We're as a business. I've been involved in the last 500 units or so. As a business, we're at roughly about 1,500 units, and we actually just hired our first employee. So it's an exciting time period for us. And I play the two main hats I wear. Number one is investor relations. It's working with the investors on the front end, having a lot of the front end phone calls, having a lot of being involved with some of the webinars, the marketing materials, things like that. The asset management stuff to keep the investors engaged. And then number two is acquisition. So a lot of the front end underwriting, a lot of driving out to the markets, touring the markets, the sub-markets, looking at the deals themselves. And there's four of us, as a business that have been running and operating over the last year together. And I think we all have different backgrounds, different mindsets, and it's a great collaboration effort that we have as a team. So I love the environment that we work in. And like I said, we had Mike Taravella is our newest hire. Actually, his first day was today, and he's coming on board to help us as an associate, of course, because it's kind of an all-encompassing thing. Because, like I said, we all have to wear a lot of hats starting off. So that's where we are today in business, and overall, again, it's been a great journey so far.
Awesome. And so, I've learned a little bit about Rand, and obviously I've seen your all's growth and keeping up with you all a little bit. And I get your newsletters as well, by the way.
Excellent.
Yeah. So it's good. It's good stuff. I love seeing, just good people doing great things, and just the growth you all have had. So, let's dive into a little bit about, what Rand is doing right now with the quote market, end quote, the way it is. And, we hear that all the time. And, just what you all are looking for in deals, maybe how that's changed or how you're looking for it to change going forward.
Yeah. It's really an exciting time in the market right now, right? Everything with interest rates getting cut further and further, we're seeing a lot of shifts in asset prices and the way that buyers and sellers are operating. And everyone, I think, is realizing that it's only, the end of this bull run is only so far ahead of us, right? So I think a lot of us are looking at, number one, how to preserve capital, how to protect our downside, and then number two, how to still create an attractive enough opportunity for the investor base and for ourselves, right? So for us, really our bread and butter has been from day one, workforce housing. So a lot of what we look at when we say workforce housing is usually that sweet spot of the 40 to say 60,000 median income range for the most part. We're typically catering towards residents that work in, say, retail. Maybe they work in restaurants or, retail employers, or they work in blue collar. They might work in industrial, really just your working force, housing that is going to provide just a safe and clean and affordable. I say affordable, not in the sense that investors are used to it, but in the sense of just a reasonably priced place to live. That's managed well, that provides good quality service. We do all of our management in-house. Jake leads up the RAM property management, so every single asset is self-managed. So we really emphasize that at a high level, is just providing good customer service and making sure that we're on top of it, and really being hands-on with operating each property, really, really effectively. And then typically on the purchase side, we're looking at assets currently. You never want to put yourself in a box completely, but I'd say 9 out of 10 assets that we look at are in the, built before 2000s. They are, so you're going in at a heavy discount to replacement cost. You're also going in to an asset that, typically is going to be cash flowing from day one. It's usually stabilized from an occupancy standpoint. So we're able to go in with agency debt. We prefer long-term, fixed rate financing, because I think that does protect, your downside from one of the risks, which is your interest risk. Especially right now, it can be really attractive financing rates. So we're definitely trying to take advantage of that. And of course, we're always looking for, operational inefficiencies. We're looking for rents that are, below market, like everyone else, typically in the value add space, but we're also looking for other income streams. And we've done a good job at being able to produce on many properties, as much as, 15% or more in some cases of additional income, just through maximizing different fee structures, things like that.
You named so many things there that we could talk about, but that's good. I appreciate you elaborating on that. And one thing early on you mentioned was, an exciting time in the market. And, elaborate on that a little bit, because, I hear mixed emotions about that, right? Oh, it's, I hear, over here, it's a very scary time. Over here, it's exciting time, or,
Well,
or we just don't know what's going to happen. So, elaborate, please.
Yeah. So I think it's all, in the eye of the beholder, in a sense, right? It's all how you're viewing it, because it's not an easy time in the market, but it's an exciting time in the market because there is uncertainty out there, in a sense, right? I think we all feel certainty in multifamily, right? And I think that's why there's been an increase in investor demand over the past few years. And that's why in many markets right now, things are getting hot. Things are getting, cap rates are compressing in many ways. So I think that it's exciting it's because it's almost like an experiment, right? Because for a long time, multifamily was not this front leader of the commercial real estate world, but now there's been a heavy increase in uncertainty in other asset classes in the commercial real estate world. Multifamily seems to be the one that still possesses the most certainty, but at the same time, we still need to hit certain risk-adjusted returns to make it the best investment for the folks out there. So I think right now you're not seeing as many, I'd say, layup opportunities, right? These are a lot of 3-pointers out there. Something that's going to take a little bit more of a savvy investor with the right mindset to see the opportunity, right? Things that maybe your everyday investor kind of skims over in the financials, whereas certain people are able to go and really take a close look at things and sharpen their pencil and find create the opportunities essentially, and that's exciting. And then also you see that. Right now, with the interest rates right now, I think, interest rates have been lowering to, I think it's the lowest since middle of 2017 again. And I think so what's cool and really just the short-term blip of where we are this week at this moment is cool to see that. I think it opens up buying opportunities in a sense, because I think that a lot of times, yes, pricing will adjust with interest rates, but I think there's a lag, because I think that oftentimes we underwrite to where interest rates were a couple months ago, not to where they are today, right? So you have to really be keeping a good pulse on where interest rates are today. Make sure you're updating, your underwriting to the spread. And then I think sellers don't always notice it as well right away. So they might have came up with a certain price a few months ago, and at the same time, as an investor on the buying side, you're able to kind of capitalize on that, because you're able to get a better rate than what it might have been initially underwritten at. And then if you're a holder, if you're holding assets or you're a seller, it can be a win-win, because your asset price will go up with time as rates continue to go down, and we'll see where it goes and see how far it goes.
Yes, it's amazing how just a little bit of interest rate change will change your underwriting, right? Yeah, I mean, and I may add $50,000 a year
Absolutely.
of income. I mean, just immediately. It's so I really like that you made that point. You got to keep up with that so you know that you're underwriting properly, because it could go the other way as well. Right.
Yep. Absolutely.
Yeah. So, you mentioned like protecting capital. And I know, you talked about cash flowing from day one, it's stabilized, long-term fixed debt, rents below market. Any other ways that that stand out to you that you all been able to protect capital?
Yeah, so I think it's a great question, and a lot of the points that I touched on earlier were more so the economics and how you're looking at the deal on
Right.
paper, right? But there's also the outside factors that you need to really make sure you're paying close attention to, right? And I think it's looking at the employment basis in the near submarket to the property, and seeing, if the major employer in your area goes out of business, what are you left with, right? And that's why I think it's really important to be looking at more so major, MSAs, right? And they can still be, they don't have to be all primary MSAs, but I think a lot of secondary MSAs can still be great opportunities, or even tertiary markets can be great opportunities if you really know the area and you see the employment base. But I think you don't want to find yourself in a position where the deal makes perfect sense on paper, but then some of the major employers move out, or certain industries shift, because there's been all kinds of shifts lately, and you can't let one big shift put you out of business, or drop your occupancy levels, or your rent rates. So I think it's really paying attention to that. Having the right insurance if you're exposed to any natural disasters or anything like that. So I think there's definitely other factors outside of just the economic,
Sure.
the spreadsheet math that you need to really make sure you're also paying close attention to.
So, and you'd briefly mentioned too, like making, and I can't remember your exact wording, but you said like how to make an attractive opportunity. Any ways that can you elaborate on that a little bit, or maybe ways you all
Yeah.
made an opportunity more attractive?
Yeah, absolutely. So a lot of the time, it's we promote heavily, buying on actuals, right? And you want to buy at a place in which you feel very comfortable with the actual performance based
So
on the.
tell me, just in case somebody doesn't, you say actuals.
Sure.
What does
Yeah,
that
yeah.
mean?
So when you're underwriting a deal, you're typically basing it on the trailing 12, financials, right? The profit and loss statement. And when you are underwriting a deal, typically the first thing you want to do is see where the deal is today, right? And then from there, you can start to ask yourself the questions of where can it be tomorrow, right? And to me, when you look at buying on actuals, it's buying at a place where you have a certain level of security and you feel comfortable with the deal upon purchase, right? And I think that's a lot of where the capital preservation comes in, is where are you purchasing? If everything went wrong, if the market just crashed tomorrow and this employer moved out of town, what are you left with tomorrow, right? And it's kind of like stress testing. It's not as fun to think about it, right? I forget where I've heard it, but I've heard of negative visualization, right? And actually being able to look at the deal and just pretend that everything went wrong, and then think, what could we have done better? What could we put on the front end, right? But I think looking at that as you're underwriting a deal and looking at it, where is the deal standing today? And then determining if that level of risk is something you're willing to do. And everyone has a different level of risk. There's a ton of different investor profiles out there. That just, I've just went over what ours is, currently. But I think that, number one, you want to start with the actuals, but then number two, like you said, how are you creating the opportunities, and what can savvy investors do to find opportunities? And I think it's really knowing your numbers. And for us, having a property management company has played a big role in this, because we really know what our rates are for every line item, right? We're not just basing it off what the previous expenses were. We're basing it off what our expenses are, right? Because we have plenty of history over many years of what our deals run at for repairs and maintenance and for marketing and things of that nature, right? So number one, start with the expenses, and you always want to give yourself a certain level of cushion, but I think the more deals that you manage and operate, the more comfortable you are with your expense numbers. So that cushion might not have to be as heavy, where at first you might just be, you might almost feel like you're guessing on these line items. So you want to build in a 30% cushion, because you have no idea, right? And I think that you can get a little bit more accurate. The more deals you manage, you can start to narrow that cushion down to a point where you can really pinpoint what the expenses are likely to be for each and every one of the line items. And then from there, it's going ahead and creating additional income streams. And then, in our instance, it's similar with the management company. We typically charge move-in fees, which is a large income stream for us, because instead of security deposits, we'll charge non-refundable move-in fees equal to 50% of the rents, right? So that alone is something that we can start to model out and assume that maybe 40% of the residents move out in the first year, and you have that, you might want to put that number in, or maybe we can be on the conservative side and assume 20% or 30%, right? And then you can also create additional income streams. I know, if it's the right asset class, you can do valet trash, or you can do, a lot of people are getting creative. I'm seeing stuff, I've seen car washes, dog washes, I've seen all kinds of creative ideas. So I think that and it really does somewhat depend on the class, right? You're not going to, someone that's in kind of a C class, older build in tertiary market is probably not going to need a dog wash and valet trash, right? But you have to pay attention to what kind of asset you're looking at, and then determine what the market calls for with other income streams. And then I think the other one, which is probably most focused on because it can make the biggest impact, is also what is the income growth from just what is the rent growth going to be, right? And are you buying at a level which is say below market rents, or is there any kind of rehabs or improvements that you can do to achieve higher rents based on what the comps in the area will show you?
So the non-refundable move-in fee, 50%. Will you all do a deposit on top of that, or is that kind of take the place of that?
So we do what we call a sure bond, and the surety bond is pretty much it's usually like an $80 bond that they're going to purchase, which is going to go to a pool, collective pool of bonds, so that at the end of at move out, if they do need, if they have caused damage in the property, and we do need to ask them to pay for that, if they don't pay for the damages up front when we ask, then we have a collection of bonds, and it will hit their credit if they move out and they don't pay for the damages caused.
Like it. I have not heard of that. That's awesome.
It's something that's unique. Actually, Jake had spearheaded that many years ago, and it's something that we really don't see very often. But for us, it's really became a net win-win, because, as I mentioned, the resident that we typically cater to are typically in not the lower end, but I'd say the higher end of the rent by necessity folks, right? And I think that for them, oftentimes they're focused on the short term. How much is moving going to cost me, right? They have to pay for moving trucks. They have to move all their furniture. They have to pay for their first month, sometimes first and last month rent. And then they have to pay for, this big security deposit, which is usually equal to a month of rent. When they find out it's half as much money out of their pocket on the front end, even though it's not refundable, they might be excited. And I think a lot of people, they assume when they put the security deposit down, they're not going to get it back anyway. So,
right.
I think we typically find it's a net win-win, and it's always good when you can do something that, makes both parties happy in an exchange like that.
Yeah. And that's so smart too. I can see where, and I mean, it's unfortunate. Somebody that's in that position, they're having to rent, they're there, and most of them will only look towards Friday. So if they only have to come up with half the money, they're not worried about when they move out.
Yeah, there's typically not like a discounted cash flow analysis for the second half of it, right? So I think it typically is actually it can be a pleasant surprise for some folks. So.
Yeah, you mentioned other income streams. Are there other income streams that we haven't mentioned that how you all have been creative?
As for us, I think the move-in's big one. Pet fees are standard. I think most of what we do is going to be somewhat in the realm of what you see out there. Nothing super out of the box that's coming to mind right now.
Okay.
But expenses, I think expenses we've done a good job at, because with I think it's partially due to a lot of, we do have some higher end newer build product. We are typically serving kind of the workforce housing. There's less of creative amenity ideas as you will have in stuff that was built say after the 2000s, or that's in a primary in say Orlando or something to that effect. But with expenses, I think we're very very conscious of every expense we're running, and we've been able to do really, really well. Just on one of our recent acquisitions, we had an instance where we were able to basically cut the garbage bill by $1,500 a month, which is saving us $18,000 a year, right? So and that's one phone call. You're saving $18,000 a year, right? So I think there's a lot of ways that you can also you can do a lot on the income. We probably get creative more so in the expenses.
Yeah, and that's probably a lot from having inside management.
Right.
I mean, all those numbers adamantly. I mean, just very well.
And we have Jake, who doesn't sleep, and he just he's just on site all the time, looking for any way he can better it. So
it's awesome. And so I know you all purchased a property in Louisville, or maybe more than one now. I'm not sure.
Yep, we have two
Awesome.
acquisitions. Yep.
Congratulations to you all. And
Appreciate
so how did the management work? I know you all are managing yours in Tennessee, and then all of a sudden, you're purchasing a property that's quite a few hours away. Did you all manage that property right off the bat?
Yes, that's a great question, right? Because I talk to a lot of sponsors and guys that I meet with usually on a regular basis. And for many sponsors, they're asking themselves, when do I go into management, right? And typically the conversation leads to a certain point where everyone says, well, you have to get scale first, right? In our case, that was not the case. Jake actually started on the first 25 unit. He was knocking on doors, physically collecting rents. And so it's actually grown very organically from day one.
Still doing that, right?
I think he might once in a while when he gets bored. But so ours has grown kind of organically. So there's no, I guess, right or wrong way to do it. I do also understand why you'd want scale though, right? Because what happens if you only have one property and you have the ability to hire 3 employees and one of them quits, right? You don't have anyone that can quickly sub in, or you don't have someone that's on HR duty hiring quickly to get. So having scale plays a large effect to management. With Knoxville, we have roughly 1,000 units here, a little bit over. And, that we have a really great scale here to where we even have like in-house construction and a CapEx team. So moving up to Kentucky was actually a big, it was a big undertaking for us of being able to go. First, we found a market that we feel comfortable scaling in, because any market we choose, we're not just buying one asset there. We have to double down and scale there, because the way that we manage properties, it just makes sense to do that. So we had our first acquisition there at the end of last year. And we were just, I know Jake and then our regional Jennifer were very hands-on with going up to the property oftentimes, and I would take trips occasionally with them as well, especially when we had new acquisitions to look at. But we'd be on site typically, just being able to make sure that everything's going smooth with the new management. We were very fortunate. We had a great community manager off the bat who had a lot of property management experience. We don't always hire with experience. A lot of times we look more so for character and customer service aptitude. But in this case, we had both. So we had a really, I guess, home run hire on the first one there. So that worked out really well in terms of our first acquisition up there. And then we hired maintenance to follow, which have worked out well. And then we had the second acquisition. The first one was 132, the second one being 243. So now we have some scale up there. And the second one, you're going to have a lot more, full-time employees on site. And what we've actually done is, because we had such a good, we felt so good about the hire on the first one, we actually had, basically promoted her to our, regional, so to speak, in Kentucky, so that she could also not only just manage the first property, but also play an active role in taking over, doing the due diligence to take over and helping build out the team up there for the 243 units, and that's been really good so far. But I think that's why management in itself is its own beast, and you have to really have it in you. Like I think that some people, they're just probably, it's not a fit. It's not a good or bad thing. It's kind of a lifestyle decision, right? Because management can be the bulk load of your time. If you're running this kind of a business, management can take up a lot of your time. It could also take away time from acquisitions. It could take away time from a lot of things, right? And if people want to travel a lot, right, then you maybe shouldn't manage, right?
It's such an important piece of the game, though. I mean, so it has to be done well. It
has to be done well, right? And if if you're not committed to giving it your all and being hands-on, then you're better off being a good asset manager and being actively in touch with your third-party property management and letting them kind of get into the weeds with the management side. So it's just, I just share that because I know there may be some people on here that are asking themselves, should I manage or shouldn't I manage? I think it's it's really more of there's no right or wrong answer. It's not just about the money that, it's not about the property management fees. It's about, I think it's more so it's something you do for control of your assets. Mm-hmm. Because what I really love about the fact that we manage is because at the end of the day, there's no passing the buck, right? Basically, if we had a third party management and the property is underperforming, we could just say, oh, it's the management team. Let's kick them out. We'll get a new group in there. Right. But for us, we find, it stops and the buck stops with us, right? So if the property is not performing, we can't really blame the management because we are the management as well, right? And investors, of course, have different rights to be able to vote out the management and things like that if it ever got to a certain point. But really we are completely responsible down to the core, which I think builds trust, but it also adds another layer of responsibility.
So changing gears just a little bit, Dylan. I know there's many people that are listening that are, many experienced, very experienced, and then there's also very many that are just trying to get into this business, and they're wanting to be syndicators, and they would love to be in your shoes and working for somebody like Jake and Gino. So I just wanted to ask, what was it about you that Jake and Gino said, okay, this, Dylan he's got what we are looking for, or this stood out to them to get that position with somebody that's in their position, to be able to work for somebody or intern or become a part of a team like that.
No, I love that you asked that question, because it's definitely something that I do get asked a lot, especially from I think younger folks in general, right? Because I think that starting off working with folks that have experience and being able to partner and build together, I think it goes such a long way, because it's invaluable what I've learned from these guys, and I'm so super grateful for the team I'm around. But the question is, how do you get there, right? And I'd say what the answer is not is just basically just asking someone, what do you need help with? Right. Because I think that at a certain point, we get a lot of people reaching out, just, hey, what can I do to help you? Right. And it's just a generic kind of blanket statement. Right. And it doesn't really, click well. It's almost like, it almost feels like you're looking for something more than you're actually seeking to serve and help. Right. So I think it's actually being thoughtful about different ways you can add value. Right. And I say in this space, you have to either, kind of seek to serve or pay to play. Right. A lot of people pay to play and invest into different, coaching and mentorship and the education, businesses, because there's a lot of great coaches out there and a lot of different systems, and it's not an easy business to learn on your own. So it makes a lot of sense, right? But seeking to serve is the idea of actually being able to find, ways of adding value. And for me, I think I took a unique path, because the business that I worked for initially, and in San Diego, was both a investment business and also an education business. So I knew a lot about the education business, and I saw that they were, kind of growing in their own education platform. And I had made a transition to basically commit to going full-time in multifamily. But I also saw at one point, talking to Gino, I saw that, they were looking to build and grow their education business. So I was able to provide different resources and different ways to be able to help them essentially, grow and scale in that way. And I did that more out of just, not really expecting anything in return, right? But through that, we were able to build a relationship. And then, over time, as I was growing in my knowledge on syndication, I spent a lot of time shadowing Vinny Chopra, who's I think's also been on your show, right?
A few times, yeah.
Yeah. So Vinny's a great friend of mine, and definitely was a huge inspiration to me and mentor to me as I was learning the business. And I was in Atlanta, so we actually did some on-site tours on his properties and things like that. And I was seeking to serve, finding different ways I could help him as well. And then in that process, I had learned kind of the syndication aspect. Jake and Gino had and our partner Mike, had all collaborated and built an awesome business yet to do syndication. So it was almost like a perfect time where they had this foundation built. They had, the management systems down, their internal systems down. And then for me, I came on knowing the syndication side and being willing to, kind of broaden the bandwidth by being willing to take all the phone calls from the investors, which we've had, hundreds of over the last few months. So I came in to basically help initially build the investor base, have a lot of the pre-existing contacts, find different ways for us to start to market and build, a significant base. And then also to play an active role in the acquisition side, because I think that, just having that extra bandwidth allowed us to go much further. And I think it was just like it was an awesome synergy, because I found like a creative way where I could come in and bring something unique to the table, and they brought unique. So it's one of those things where, my path was my path. And, I like the Steve Jobs quote where he talks about, you can never connect the dots looking forward, but you can always connect them when you look backwards. Right. And I always say that, when someone's really looking to get in this business, if you're committed enough and you're really, really serious, and, you're really in it for the long run, and you just keep doing the right things again and again, you'll find your path, right? You'll find what works for you, whether it's a deal you come into. For me, my first deal was 21 units with a few friends up in actually upstate New York, in a place I used to live in. And, things will click with you if you just keep your head down and just keep doing the right things and stay patient. Don't rush it. So.
No, it's awesome. And unfortunately, we're about out of time, but
Sure.
there's so many questions I'd love to ask you that I know the listeners have for you as well. But, because you also do, I'd love to have you back on and us just talk about investor relations,
Absolutely.
some of that. And, but
Love
I
to.
want to ask you, what, your top advice for taking care of investors.
Top advice is really pour into them and show care, and try to put yourself into their shoes. For instance, what we do, we send out, investor gifts when we close on a deal. We do a lot of, webinars where we're being completely transparent and showing them what we're going through, challenges and opportunities. And even last week, we just went out to New York because that's where the majority of our investors are. And we had about 60 or so people come out, and we just did an open bar for them, bought food and drinks, did not speak, did not pitch, did not do anything else. We maybe spoke for 30 seconds. And it was literally just FaceTime with the investors, just getting a chance to kind of build relationships. At the end of the day, this is relationship-based investing. No matter how many crowd streets there are out there or how many sponsors are on the internet, it's always going to rise and fall in relationships. As a passive investor, you should always focus on the relationship first, because when things do get tough, which things will and will get tough, it's only a matter of time, for any sponsor at some point. You want to make sure that the person you're working with is actively caring. They care about you. They have the right ethics in place. So just don't forget about the relationships.
Relationships are so important. So important. So what's been the number one thing that's contributed to your success, Dylan?
Number one thing for me is I'm a big learner. I love learning. When I started in this business for the first 12 months, I didn't let a single day go by without learning, taking CCIM classes, online courses, working with coaches, picking people's brains. And I think I still, fall into that category. I'm one of the few people that, I love reading through a PPM. It's the most boring thing in the world, but I love just learning about different ways that deals are structured and different ways that, things take place, whether it's the legal side, the accounting side, the real estate side. So I think it's just having a passion for educating myself.
Nice. And unfortunately, we're out of time, but tell the listeners how you like to give back.
For giving back, my big thing giving back, number one, I think just where I am in life at this point is mostly just helping other folks through real estate investing. I think it's, I've done some coaching and mentorship, and it's definitely really fulfilling to be able to help people that are on the path or maybe a few steps behind on the path, or collaborating that are even further ahead on the path. But I think right now that's my big focus. And I think down the road, I have different ideas in mind. I think, I think I'm very passionate about the idea of somehow impacting just the overall education system. I think that's one of the biggest things we're missing as a country in some ways right now. I think it's very outdated. And I think at some point I'd love to play an active role in being able to make an impact along those lines.
Awesome. Well, you'll have my support. So, Dylan,
right.
You've been a great guest. You've provided so much info. We've actually gone quite a bit longer than normal, just because I've had time, and you've been a great guest. But, tell the listeners how they can learn more about you and get in touch with you.
You can reach out to me, my email, dylan@randpartnersllc.com, Instagram @Dylan Marma. I'm pretty active on there as well. And then, of course, follow this show, our show, Wheelbarrow Profits, as well. I'm on there. Jake and I do a show, also started a few weeks back. That's going to be the Rand Partners podcast, where we also plug in for different tips and tricks that we're actively performing in the business.
Awesome. See, I didn't even know about that one. That's great.
Yep. Well, now you know.
Yeah, now we know. Now everybody knows. And thanks again, Dylan. We appreciate all the listeners being with us today and every day. And I hope you all will go to LifeBridge Capital and connect with me in the Facebook group, The Real Estate Syndication Show, and also go over and check out Wheelbarrow Profits. They're going to add tremendous value to you if you do. So appreciate you all being with us, and we will talk to each of you tomorrow.
All right. Thanks so much, Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.